Hi everyone. In this video, I'm going to explain how to determine the present value of a single or annuity amount using Excel. This concept can be used for math, accounting, finance, or even in setting up your personal investment and savings plan. Whether you're trying to solve for the present value or future value, you'll generally need the same key data: the amount you want to invest or the amount you plan to have at a future period of time, an interest rate, and the length of the investment period. I'm going to discuss how we're going to use those various inputs into Excel to get the present value of certain factors. Before we do that though, what you have to realize is that interest rates are always based on an annual period. Therefore, if you're planning on investing a fixed amount routinely over a period of time, that is more often than one time a year, so let's say doing it every month, you're going to have to prorate the interest rate for any computation you do to then get to a monthly interest rate or a weekly interest rate. And I'm going to start with a fresh page. I might call this time value of money, and we're going to start with understanding present value. I'll do a separate video on future values. So the first example I want to do is the present value of a lump sum. In other words, how much should I put away or invest now to meet future financial need? So thinking about this using a timeline, let's assume today is the 1st of 2022, and I want to figure out how to compute the present value of a future amount doing a lump sum calculation. For example, if I know that I need $100,000 in 10 years, what amount do I need today, assuming the average rate of return on an investment is about 5%? In order to do this in Excel, I'm going to use the present value function. And essentially what it's going to do is it's going to take that investment and show how that investment grows using interest. We call this compounding over 10 years, because not only will my initial 100,000 grow, but every year that I earn interest, that interest will also grow because I will earn interest on interest, which is the concept of compounding. To do this in Excel, we'll need the following inputs for our example. So here we know the future value that we want is 100,000. I stands for interest when we're doing this calculation, and our interest rate is 5%. We're going to assume that interest compounds annually, so just once a year. And then N is the number of periods that we're looking at. In this case, we're looking at 10 years, so N equals 10. I'm going to go ahead and start my equation on A5. So if you're trying to match my formulas exactly, that's where I'm going to be starting my titles, and then my computations themselves will be in column B. So first I'm going to include my years of investment or time, my N factor. I'm going to expand my rows so everything fits nicely. And I'm going to say 10 for N. My interest rate in this example is 5%. That's an annual interest rate, so make sure you keep note of that. And then my savings goal or future amount that I would like to have, in this case, is 100,000. Okay. Then I'm going to figure out my calculation using Excel. So present value of future spend is computed as follows: equals, and then you're going to go ahead and put PV for present value. And it even tells you in Excel, returns the present value of an investment, the total amount that a series of future payments is worth now. So of course we just want one future amount, and we want to backtrack it all the way 10 years, knowing that amount is going to grow at 5% a year. In Excel, it is going to ask us to complete a calculation that has first the request for your rate, followed by your number of periods, so N. If we were making multiple payments, we would put those annual payments here, or quarterly or monthly payments. And then what is our future value that we're trying to obtain? And then finally, type has to do with whether we want interest to accrue on the first day or the last day of the year. So knowing that our rate we have interest is 5%, my number of periods, my number of years is 10, so I'll link to cell B5. And then I don't have an annuity payment. I just want to figure out what the future value of this is if I just left it alone, or what the present value of a future amount is if I left it alone. So I'm going to click another comma, and that just skips over the need for payment. And then I'm going to click the future value. And this is the number I hope to have in 10 years if I put money away now and it grows at 5%. I close my calculation off with a parenthetical at the end and I hit enter. So this is telling me that today, if I put $61,391 in a bank account that earns 5% a year, or maybe a CD that earns 5% a year, at the end of 10 years, I will have $100,000. If that negative number bothers you, just go ahead and put a minus sign in front of the PV, and that will adjust it to get you to a present value that's a positive number. You can use this for a whole bunch of accounting concepts too. A lot of times in accounting, there's calculations that will ask you for the present value of a bond or a present value of a note, and you can utilize Excel to calculate those formulas the same way. By setting it up this way and not just putting the values in the cells above, we could do that. If we wanted, we could say equals PV, or maybe negative if we don't want a negative number. And then we could just put in 5%, 10 years, skip the payment, and $100,000 right into the calculation and hit enter. You'll see we get exactly the same number. But the reason I don't do that, and that I like to go ahead and put it up here, is because if I have this in Excel and I want to refer to it in the future, I can then update my calculation. It's telling me put away $37,688 today. And in 20 years with 5%, I'll have $100,000. Next, let's talk about what to do when we are trying to determine the present value of an annuity. An annuity means you're making routine payments often. For example, let's assume that we want to calculate whether you have enough money today if you stopped working so that you can spend $50,000 a year for the next 30 years and not run out of cash. How much do you need to put away today to be able to do that for the next 30 years? Let's also assume that we're going to have an 8% return on our investment. So using the present value calculator in Excel, it's going to take into account both the use of the $50,000 a year that we'll need, as well as the fact that your balance will continue to earn 8% each year while invested. And then find the number of years we're looking at, which in this case is 30. I'm going to go down a few rows here and start our calculation on, let's start it on B14. So I'm going to again have my years of investment of time, so 30. My interest rate that I'm looking at is 8%, and my annual funds that I'm going to need, my annuity amount, is $50,000. To make this a dollar amount. So this is also known as the annuity payment. Again, I'm going to use my present value. So my present value of future spend, that's how I like to think of it, is going to be my PV. I need my rate. So my rate is 8%. My number of periods in this case is 30 years. And this time I have an annuity payment that I'm going to need. So 50,000. I don't have a future value. My future value is using that 50,000 every year. So then I'm going to skip my type and my fair value, and I'm going to say 1. I'm going to say beginning of the period, and the reason I'm doing that is because I probably need that 50,000 at the beginning of each year. So I'm going to make that 1. Interesting is if you think about it, if I were to take $50,000 times 30 years, without doing this calculation, I would have thought I needed $1.5 million. And that is a very daunting number. So what's really happening here is that we start with 607. Every year, we're going to spend 50. And we would think that decrease would go down way faster than 30 years, knowing that 50 times 30 is 1.5. But we're also growing interest at 8%. And so our balance is growing as we're reducing it. Let's go ahead and prove it out. So if I want to prove this out, I could start with my balance on year 1. So let's make sure this really works. So assume in year 1, we'll go ahead and copy this down. Okay, my balance that I just computed here is 607. So the question is, if I spend $50,000 a year, am I really going to get down to perfectly zero at the end of the 30th year? Well, my annuity that I'm going to spend is $50,000 a year. So we'll go ahead and assume that's reducing my balance. And then I'm going to have my adjusted balance, which is just my beginning of year, plus my negative payment, or reduced for my payment. And then I'm going to assume that throughout the year, I'm going to earn that 8% interest. So I'll go ahead and put a column for 8% interest. And I'm just going to take that balance at the beginning of the year and times it times 1.08. And so the idea is it's going to give me my balance grown by 8%. So what happens is, even though I'm taking 50 out, I'm putting almost $45,000 of interest into my account by the end of the year, which is awesome because it just means that I'm not going to be really depleting my balance by as much as I really thought I was. So let's copy that down. So my 602, my new balance, I'm going to make that equal last year. And then I'm going to go ahead and copy my formulas down for year 2. Oops, I'll go ahead and make this equal 50. So again, I have 602, which I equaled my ending balance from before, 50,000 payment. My adjusted balance is the difference between the two. And then when I grow my interest, I'm at 596. So when I get second year done, second year is a little different than first year, because first year I'm just linking to a balance. And second year, I want to link over here to my ending balance. I'm going to go ahead and copy these all the way down to year 30. And if I've done my math right, if Excel has told me right, I should get to 0 at the end of the day. And I do. Look at that, exactly 0. If my interest rate was like 10%, then at 10%, I would actually increase my balance by more than what I'm utilizing year over year. So back to my calculation. Let's assume now today is January 2022, but I'm not retiring for another 20 years. So my retirement date is 12/31/2042. And I hope to live another 30 years past that. So I need my 50,000 every year. And I've done the calculation to figure out that at my retirement date at 2042, I need 607,920. But I'm not ready to retire. So what do I need to put away today to ensure that I have $607,000 on 12/31/2042? I can use the same concepts that we just did for our lump sum to take that present value all the way back to today. So continuing to work through this problem, erase this 1.5. Again, I have my years of investment of time. I could really just copy all this over, can't I? Copy and paste my interest rate. Control C is for copy, Control V is for paste if you're just getting familiar with Excel. I know that I'm gonna do 20 years, and let's say I can still continue to have an 8% interest rate, and I want to save this 607, so I'll link it to that. What do I need now? Again, if I'm doing my present value calc, equals PV, my interest rate is 8%, my number of periods is 20 years, my payment, I'm not doing an annuity payment here, I want the lump sum, the present value of the lump sum of 607. So I'll skip over that with a comma, keep that empty, and then I want a future value of 607. I'll go ahead and close up my calculation. Again, I'm going to make this negative because I don't like seeing negative numbers. This is telling me that I'm going to retire in 20 years. If I put away 130,428 today, and that grows at 8% over the next 20 years, that will give me 607,000 by the time I'm ready to retire. And that will afford me a life where I could spend 50,000 a year for 30 years and spend all of my money, but not run short of money if I make it that entire time. Understanding how the time value of money can help you invest and reach your investment goals can be very powerful. Look forward to my next video in which I'll talk about not just present values, but we'll look to understanding future values. So maybe what do I invest today? If I can have a certain rate of return, what will that give me in the future? If you have any questions, feel free to post them in the responses to this video, and I will try to provide some feedback. Going